Hi, I'm Paige Deers. I'm here with Tom Fish. Let's talk about real estate equity, Tom. A lot of growth in that market. What are you seeing?
Well, we're seeing it in three primary areas, acquisitions, development, and recapitalizations. So obviously there's still a continued desire to acquire properties at good yields. We're seeing a lot of equity joint venture opportunities there. We're seeing a lot of equity joint venture opportunities in the new development side, although that's being curtailed a little bit by some of the markets that have seen a lot of new development already. It's starting to finally branch out into either some of the secondary markets and some of the suburban markets in the primary areas. And then third, recapitalizations. This is kind of one of the new interesting, fun trend that tends to be more off-market, where equity capital can come into existing projects, taking out one equity source that maybe wants to harvest and get in on a new basis. The new equity comes in on a new basis. It's not an on-market transaction necessarily, so they didn't go out and buy an asset that's been bid up through a full sales process. Mm-hmm. We're seeing a lot of activity in that arena, a lot of capital that wants to be able to come in and manufacture a good yield through current low interest rate environment.
And I think that would be a good opportunity to do it because, hey, you've got a lot of assets here that now property fundamentals are better. You probably do have some cash you can take out of the deal. What part of the market will really be doing that? Is it a huge part of the market, or is it niche players?
I think it's a growing part of the market that sees still a relatively good risk-return ratio, especially when you can go in and get really good current returns like you can now. If somebody wants to go out and generate a 10 to 12 internal rate of return, or maybe a 13 to 15 internal rate of return, you can get a reasonably good portion of that on the current side as opposed to having to wait for the appreciation side. We live in kind of a good environment right now where 2% GDP growth results in 2% treasuries, which results in very low interest rates for real estate. But we're still in a growing economy, so we don't have real estate fundamentals going the opposite way. Right. So we get to finance with great low interest rates, have sustained, albeit maybe slow, property performance growth, but manufacture a great current yield all along the way.
So you see good current yields, but there's got to be some challenges out there. We might see rising rates. Do you think that'll have an impact?
It will have an impact when it happens. We don't know when it happens. We think about it every day. We have a lot of reasons for rates to go up, but a lot of reasons for them to stay down. And we don't have a level playing field right now. We don't have a market that is being left to its own devices. It's being manipulated by the Fed, and when the Fed decides not to manipulate it anymore, I don't know when that's going to be.
Okay. Well, we'll keep watching it. We'll see what they do with the QE. Right. Thanks so much for sharing your insights with us. Thank you.